Right now, it's time to welcome Peter Cardillo. He's currently the chief market economist at Spartan Capital Securities. He has more than 50 years of comprehensive professional experience in financial services. He started at the age of 12. Peter is also a frequent commentator on media outlets including CNBC World, Bloomberg, the New York Times, and the Wall Street Journal. Peter, thanks for joining us today.
My pleasure. Thank you for having me.
So, in a recent article that appeared in theeconomictimes.com, you mentioned that the bond market is sending a message of fear, that the economy is slowing down. What do you mean by that, and why do you say that?
Well, there's no question that the economy is slowing down. We have some economic indicators that are still pretty good, but there are other indicators that are pointing to a slowdown. In fact, just today, we got the leading indicators that showed a decline. They were down 0.1%. I want to also point out that the lagging indicator was actually up by a 0.5%. But that's a good indication that the economy is slowing. Then if we look to the housing market, you know, for a while there we had some real mixed signals, but now it seems that the trend in the housing market is definitely to the downward side. And then, of course, you know, we have some strong indicators. For instance, today we got the jobless claims number out, and certainly they are very strong. They continue to indicate a very tight labor market.
Sure.
They're at a 49-year low. Okay. They haven't been this low if you take the 4-week average since 1969.
So do you agree with my statement then that the bond market tends to be smarter than the stock market in many ways, that the stock market seem to have the blindfolds on and be marching north, whereas the bond market is putting the brakes on?
Well, I think you're right in saying that the bond market, you know, has more sophistication than the stock market. That's not to say that the stock market is not a good barometer. Absolutely not. But the stock market, the bond market usually gets it right. But what is the bond market fearful? And what are investors really fearful? They're fearful of the trade war lingering on. And if that happens, you know, we're on the path to isolation. And isolation is never good. Isolation, you know, if you go back in history,
sure.
back in the 1930s, you know what happened.
Right.
And so that's the greatest fear.
How about the Federal Reserve? I mean, a lot of the bond market seems to be concerned that the Federal Reserve is going to keep hiking short-term rates, regardless of what the bond market does with long-term yields. Do you think that rate's up there with concerns about trade war with China, or do you think China still takes precedent over that?
I think China takes precedent over that. The Fed is doing what they should be doing, or at least what they should have been doing, and obviously they're on hold. I believe that they'll probably stay on hold for at least two more quarters, unless the economy weakens so much, then, you know, the tightening cycle is probably over. But I'm not suggesting that it's over just yet, because the economy is still showing signs of strength. There are pockets of strength, and those pockets of strength are obviously emanating from the consumer. But that can only go so far. And
sure.
What the Fed has done, I think, you know, when you have such a tight labor market that we have, they're just taking extra precautionary measures. And rates are, I don't want to say they're at normality, but they're pretty close to it. And the Fed has basically indicated that. So I'm not blaming the Fed.
But is that really why?
I'm blaming the trade war.
But is that really why they're raising rates? But you know, a lot of people believe that part of the reason that the unemployment rate is so low is because the unemployment rate they always publish really doesn't account for all the long-term unemployed people / you know, discouraged workers, et cetera. That the real reason the Fed's raising rates is because they want more ammunition left over for the next time there's a recession. but isn't there a fear that they could create that recession in so doing?
Look, interest rates were at zero. They're just now creeping up towards normality, or maybe they're at normality. I don't know. That's debatable.
Right.
But when you have an economy that was growing, and I say was growing, at 3% plus, you can't have the Fed funds rate where they were. You need the Fed funds rate to be just slightly above or slightly under. And so, again, I think that they did the right thing. Now, you know, there are so many geopolitical uncertainties that that is what I think is really adding to the fear factor.
And in some ways,
factor
China is one of those. We need to leave it there for this segment for just a minute, but stay with us, Peter. And you stay with us too. We'll be right back here with more on the income generation. I'm David Scranton. And now it's time to welcome back Peter Cardillo, Chief Market Economist at Scranton Capital Securities. Peter, thanks for sticking around. Right before the break, you mentioned really the concern about geopolitical type pressures. But I guess what concerns me when I look at long-term interest rates, if you really have GDP growth of over 3%, you have unemployment that low, long-term rates should be higher to allow short-term rates to come up. So why, in your opinion, are long-term rates just staying stubbornly low?
You know, that's a $64,000 question. I don't know how to answer that question. And I can only think that because the market feels that the growth rate is not sustainable. If the market felt that the 3% plus growth was sustainable, I would imagine that you would see those long-term rates shoot much higher, but they haven't been. You're right about that.
So what do you see happening now through 2019? You know, if growth rate's slowing, do you see us actually seeing recession in 19? Do you see us seeing recession perhaps closer to 2020? I know it's a crystal ball question. I hate to put you on the spot, but hey, that's what I get paid to do here on television, put people on the spot. So what's your best guess?
That's quite all right. I have an opinion on that. No, I think we're going to escape recession this year. 2020, I think we get very close. In my opinion, there's probably a 70–80% chance of recession in 2020. Now, that all could change if we get a trade deal. But if the trade talks continue and there is no concession on either side, then where I would say recession 2020 is not far-fetched. And that's simply because of the fact that what we're going to see here is consumers begin to pull back. And let me throw in another factor here. The government shutdown is not helping.
No, not at all.
There's a good possibility. There's a real good possibility that maybe the White House economist, who just yesterday said that we could be facing zero growth this quarter. I don't share that view, but if the shutdown continues for another 4 or 5 weeks, that's a real possibility.
I know.
And so to make up that time, that lost growth time, you're going to have some powerful ingredient, and that powerful ingredient is to make a trade deal, whether
Peter,
it's what the administration is looking for or not.
So if it's 70–80% recession in 2020, and I happen to agree, in 20 seconds we have left, what does that mean for the stock market this year, and what do you want investors to know? 20 seconds.
I think it's going to be a bumpy ride and a very selective stock market.
Very selective stock market. So in other words, you're not out there buying indices or mutual funds. You're better off stock picking the right industries. I couldn't agree more. Peter, it's been my pleasure having you on the show. We'd love to have you back. Thank you. And you stay with us.
pleasure.
We'll be right back here with more on The Income Generation. You're watching The Income Generation. I'm David Scranton.